We're here to talk about Silicon Valley real estate market conditions for the current week. We'll be looking at weekly distributions for the past 53 weeks for three items. The first item is marketing time, which is the time it takes 3 out of 4 sellers to sell their properties. Next is sellers' expectations, looking at the average price reductions to see how the seller's expectation and the market will compare. Market competitiveness is looking at how much the buyers are overbidding when they are making their offers. Then we look at a geographical display of 20 micro markets in Silicon Valley. Then we look at market indicators for the past quarter, 14 weeks. Then we look at a 10-year history and data trends. Then we look at comparing Santa Clara County, San Mateo County, and Alameda County here in Silicon Valley. Then we talk about how to participate and how to get the PowerPoint slides, which are online. And then we finish up with 5 regions covering Northern California, 13 counties. Takes roughly 45 minutes. Each one of these is a chapter in the YouTube description that you can jump right to the sections that you find most valuable for your own needs. We're starting off looking at days on market, and this is going to be the same concept for the first 3 groups. The purple line is where we are right now. The blue line is where we were a year ago. The blue line a year ago is closer to the red line, which is the hottest market we've ever had. The market is hotter a year ago than it currently is. And we start off a year ago, minus 12 months. We jump either 4 or 5 weeks because I don't do anything on a monthly basis, but I'm trying to emulate a month by keeping as close to September the 6th, October the 6th, and November the 6th that I can. And you can see the actual dates up here. We'll step through and you can see that the market was slowing down at this time last year, and I would anticipate the market doing the same. Then you get to the first of the year and the market really accelerates. There's sort of the peak right there in April. And then the market sort of slows down and it sort of drifts. You have a couple weeks where it really doesn't change, then it changes. A couple weeks where it doesn't change much, and then it changes. And that's sort of the pattern. The solid lines are the most recent weeks. And you can see for the last couple weeks, we've been roughly moving up and down a little bit. The current week, the purple week, is the slowest week we've had in quite a while. These 2 lines are slower, but they're, back in October and November of last year, and then the market turned around. The market's following the typical trends, being longer marketing times this year than last. If you wanted to look at that, you come out here to roughly the 75th percentile, and a year ago, that was taking something like 14 days, and now it's taking something around 28 days, so almost double the marketing time. Now we're looking at the seller's price reduction. So this is sort of a measure of the seller's expectations with their asking price, which is the measure of their expectations with market reality. If they underestimate the market, then there's going to be price increases. And we've had 3 periods, I think it is, of price increases, although they are fairly rare. The magnitude of the seller price reductions on average indicates how close an alignment the sellers were with the actual marketplace. Currently is the purple line down here, but a year ago we were up here, which again is closer to the red box. So a year ago the market was hotter, or sellers were more in line with the marketplace than they are now. Or another way to look at it is currently we're taking bigger price reductions than we did a year ago. The pattern's the same, and we'll step off and we're starting a year ago, 12 months ago. And so it's the blue line, and you can see the changes. And again, this is the time of the year where it cools off. And right there, about 8 months ago, was sort of the bottom of the marketplace. And then you can see it rapidly goes up. 5 months ago was the peak. And then ever since, we've been slowing back down. And the peak, depending on what metric you use, was around April the 19th or April the 26th of this year. And here we are in the last 7 weeks, and you can see some bounce. And the solid lines are the most recent. There's a couple weeks ago, and then an improvement, another improvement, but now a major slowdown and another minor slowdown. You sort of had these plateaus and then movements. Typically, what we're expecting now, as I said a couple times already, the market to be slowing between now and the end of the year. Moving on and looking at the buyers overbidding. So this is how much competition the buyers feel. This is going to be lagging. And what's really interesting here is when the market's super hot, it only lags by 2 or 3 weeks because buyers are going in being really aggressive, especially the aggressive buyers, and are closing in 2-3 weeks. When the market is slowing down, that time takes longer. So the time lag changes. Normal escrow, you figure it takes anywhere from about 3 to 6 weeks. but the overbidding is more sensitive because the people that overbid the most are the ones that are aggressive with those quick closes. So the lag time tends to be a lot less than the 3 to 6 weeks that one would expect at the peaks of the marketplace. But it is still a lagging indicator. It becomes more of a lagging indicator as the market slows. Again, the same concept. The purple line is where we are right now, but we start off with the blue line here. The blue line is slightly better. So the market is slightly worse this year than it was a year ago at this time. Stepping through. And again, you can see the market's basically slowing down. There's sort of the bottom of the market again 8 months ago. And then you can see the rapid run up in the spring. There's sort of the peak of the market. It's labeled May the 10th, but that's because I went from April the 5th to May the 10th with not that April 19th and April 26th. Now you're getting more recent 7 weeks ago. It's onto the solid lines. And you can see some bounce, but the general trend is in the downward direction. There was a little bit of an up. But again, as you saw at the beginning of the slide, the trend will be down. The market is in all three metrics now is slower or less aggressive than it was a year ago. And this is the time of the year where you expect the market to continue to slow. Now, anything can and does happen, but that's the general pattern. And it's going to take something unusual for the shift not to follow the normal pattern. Now we're moving on to the geographical mapping of the micro markets. We start off with the first 7 here in Santa Clara County, which is 11 through 17. Then 21 through 26 are 6 micro market areas in San Mateo County. 31 through 37 are 7 micro market areas in Alameda County. And then 42 through 44 is sort of the key. So 50 to 87.5% of normal inventory is a shortage of inventory. 12.5% on each side of 100% is a normal inventory, and of more than 112% of the typical inventory is a surplus of inventory and favors the buyers. I basically look at the inventory level for the past 10 years on the same date, and that's how I define what typical is. And then we look at the ratio of the current data to that. So the only area that has a shortage of inventory enough to get pink in color is the Campbell, Cambrian, Santa Clara, and Willow Glen area in Santa Clara County. The area that's the bluest, at least quickly looking at the map, is the Palo Alto area, which has 120%, so 20% more inventory than it normally would have. The real key now is the offers, and you can see how blue the map is. So there's basically across the board a shortage of offers. The only area that's having more offers than normal is the San Mateo County coast, which is sort of unusual because that's sort of one of the slowest areas. So they must be coming up and getting a lot of activity. Sellers have finally lowered their price to the point where buyers are willing to buy. The other area is Los Altos, Palo Alto at 113%. The only areas that have more offers, but 7% and 13% more offers than typical is not that much. If you look at the shortage, the shortage area I'm seeing up here is South County at only 2/3 the inventory that you'd normally expect. A lot of the areas are right around 3/4 to 80%. So we're missing 20 to 25% of the market overall. And you can see again on how blue the color is. Now we're looking at days of unsold inventory compared to the 10-year median. And I looked at this later on. We have a slide that was a little confusing last week, but I did look into that. And basically the percentage of inventory for offers and inventory do not occur at the same time as the DUI. It just, when you look at each one individually, and I think that's because you can have a surplus, you can have that reservoir filled of inventory and have a high inventory even though you're getting a lot of offers. That explains the issue from last week for those that remember it. But anyway, here, days of unsold inventory, the higher the number, the slower the marketplace is. So Cupertino, Sunnyvale right now is one of the slowest areas compared to its normal. And we'll be looking next at just absolute numbers, but it's 50% longer marketing time essentially in Cupertino right now than it typically does. San Mateo County, North San Mateo, so that's like Daly City's at 40%. You can see Alameda County is at 6% slower. And there's only a few areas that are faster, and that would be in Santa Clara County, sort of the more affordable areas in Santa Clara County. The one exception to that rule is Saratoga Los Gatos at only 92% So 8% less than the normal level. So 8% faster speed marketing time. Now we're no longer comparing to the 10 years. So we're simply looking at the number where we are now. The slowest area is the expensive areas in San Mateo County, Atherton, Menlo Park, Portola Valley, and Woodside at 116 days. If you're looking at this, you can see a lot of the areas are 30 to 40 days overall. And basically anything under 6 weeks gets a shade of pink. A lot of Silicon Valley is less than 6 weeks to sell out your existing inventory at the existing rate of sales. And this slide is in there for the consumers that don't like and complicated concepts to understand. It's really simply, how long does it take for 3 out of 4 sellers to sell their properties? And you can see you're basically 20 to 35 days in most of the areas. The San Mateo County coast, I think, is going to be the longest at 63 days. So it's sort of interesting that they're having more offers right now, I think with 7% more offers when they have the longest marketing time. In second place is Oakland at 53. And then after that, I think you're going to be jumping down to County at 38. So it gets fairly tight fairly quickly, but basically 20 to 40 days is sort of where the range is for the most. Again, here, the pinker the color, the faster the marketplace is, or the less marketing time the seller is going to have. Now we're looking at price adjustments. So this is sort of a measure of the seller's expectations to market reality. And you can see in the San Mateo County coast is taking the most price reductions and at 3.4%. I believe it was almost 5% last week. So that's a fairly marked improvement. Saratoga, Los Gatos down here is at almost 3%. And then the expensive areas at 2.2 in right in San Mateo County. Now, one of the reasons this metric is what I call tight, where you basically go from 0 to about 2% for the most part. Yes, I just said we were at 5 last week, but that's pretty rare. And that's because most of your sellers do a fair amount of homework before they put their house on the market for sale, and therefore they don't have to sell. Also, with Silicon Valley typically having a huge shortage of inventory compared to its demand, marketing time is typically quick enough then most of the sellers don't have time to reduce their price. Go back to the previous slide. If you're selling your home in 3 weeks, you're really not going to have time to do a price reduction, and that's 75% of the marketplace. As it turns out, it's usually closer to like 85 to 90% of the sellers are not doing any price adjustments at all. So it's a very small percentage of the market, typically 10 to 15%, that when you average it out is these 3 and 4%. So those that are taking price reductions are taking fairly significant ones. Here is the frequency of ask price. So this is sort of what I was just talking about. You can see over in the San Mateo County coast is the highest amount of sellers taking price reductions, and it's 44%. So less than half the sellers, but that's already saturated blue. In fact, I go saturated blue at 33%. And you can see the next closest one that I'm picking up is, well, actually, I'll have to go up here to Saratoga, Los Gatos at 27%, followed by Oakland at 26%. And then you can see that a lot of the Silicon Valley, again, is red in color, and that's because very small percentage. And for example, in Milpitas, only 8% of the sellers are reducing their price. In Campbell, that we talked about earlier, only 14% of the sellers are reducing their price. And if you look up and down here, it's definitely less than 20% for most of the areas. Here is the buyer overbidding. So now this gives you an idea of how competitive the market is. Now this is also going to be lagging a little bit because the market is slowing down. So buyers aren't aggressive. They're going in more with the typical 4 to 6 week closings instead of trying to be aggressive with 3 to 4 week closings. But still, buyers in general are overbidding. In fact, the only area that's coming down in price is the San Mateo County coast, and they're taking a 1.3% price reduction to get their offers accepted. Pleasanton and the expensive areas are break even at getting exactly their asking price. And then from there, South County is 0.9, 1% above their asking price. The highest area that I'm seeing is Berkeley and the city of Alameda at 15.6% above. So you can see Berkeley's off the top of my graph here, but you can see the island of Alameda is the fairly significant red, and it's going to be the reddest color. Still, there is a fair amount of overbidding. It's not approaching 10%. I would say it's the number around probably 6%, 5.5% overbids. This is the frequency of overbidding. So how common is overbidding? And you can see that overbidding is actually common. It's basically between 50 and 3/4 of the buyers feel the need to offer the seller more than the seller's offering. Now, there is an exception here in the San Mateo County coast where only a third, well, a little more than a third, 38% of the sellers are getting more than their asking price, and then followed by the expensive areas in San Mateo County at 50%, but you have South County at 44%, you have Pleasanton at 42%. So 50%-ish area to about 3/4 of the sellers are getting more than their asking price is sort of the range. And again, the redder the color, the more it favors the seller, the more than the bluer color, which is basically not here, favors the buyer. And now we're looking at long-term appreciation. I try to find a year period of stable prices. The best I could find up was the last 9 months of 2015. You can see here, it's very interesting. San Mateo County basically has the least amount of appreciation. Most Santa Clara County and Alameda County has the most appreciation. I believe this is directly related to the pandemic. I'm a little surprised that Livermore is not out there, but it was up there earlier. It's just a little ebb and flows of the marketplace. Basically, as remote working became more common, the outlying areas that were more affordable with longer commutes became more desirable relative to the areas that had shorter commutes. Here's the pricing. So here color is blue is the more affordable, favoring the buyer. The red is the higher price. It's a higher price, which is usually good for a seller if they're getting a high price for their property. And you can see the median is right here in Foster City-based cities. Redwood City is pretty white, along with Campbell, and then Fremont. There's a lot of areas that are close together. And when you look, it's the middle number, 1.9 million, 1.9 million, and then these are at 2.3. So, that's still a 20% range, but that gives you an idea of how much you go, because you go to the expensive areas and they're at 4.1 million. The other thing I show on this table is the cheapest 10 percentile price in an area, the median that most everybody follows, and then also the most expensive. This becomes really useful because you can figure out roughly, do you have a chance of finding a home? So for example, if you're looking at $1 million or less, it's going to be a challenge to find a home in South County because, between 950,000 and 1.2 is 40% of the marketplace. So if you're limiting yourself to that $60,000 range from $1 million down to 940, there's not going to be that many homes. You don't know the exact percentage, but it's not going to be very many. Here's a summary of the 20 micro market areas. I've added in these horizontal lines to sort of break out the counties. So the first group here is Santa Clara County. The middle group is San Mateo County, and the bottom group is Alameda County. You start off with the active inventory, and this is compared to the 10-year median. And you can have a hot marketplace, a lack of inventory compared to the 10-year median, and still have a cool marketplace. Here's the offers, and clearly seeing the lack of offers, the days of unsold inventory compared to the 10-year median. Now you're moving into just days of unsold inventory. For example, Cupertino Sunnyvale is blue because it's 50% longer than typically is. They're still selling in 35 days. So 35 days to sell all your inventory is pretty quick, even though that is slower and significantly slower than it typically is. Marketing time is only 19 days, so 3 out of 4 sellers are selling in under 3 weeks. So nobody would call it a slow marketplace. So you have to understand a little bit on what these colors really are representing. Here's your ask price adjustments, and they're not really doing price adjustments. It's 6% of the sellers, so that's not very many, so it favors the seller. Overbidding, buyers are coming in almost 10%, 9.7% above the asking price. Frequency of overbidding is 78%, 3/4, 83% appreciation, so not quite doubling your money since 2015. The cheapest home is 2.2 million. The typical median home is basically 3 million. And the most expensive 90% home is 3.7. And I've added in the payments here, and it assumes an 80% loan at the 30-year fixed rate for the nation. And just FYI, the rate was unchanged. I'm pretty confident it was 6.35. You can get better than that by going to jumbo money here in Silicon Valley, and also by having a relationship basing. Here's looking at the 6 key indicators for the past quarter, which is 14 weeks. As I put, this is the current week over here on the right-hand side. This is the same week of the previous quarter, basically. I've added in the vertical lines so to try to line them up a little bit better. And what you basically you're saying is your inventory started off at 2,400 and now it's at 2,500. So inventory's gone up a little bit, and we've gone from 89% of normal inventory to 88.6, so almost the same. So the percentage of inventory hasn't gone anywhere. So that basically says this growth of almost 115 listings, which is about 5% of your marketplace, is very normal for this time of the year, because the change, there's been no percentage change. So the concept's the same for offers accepted. And also I should explain the gray line here is the absolute normal based on the previous 10-year median. The blue is the least you'd expect and the red is the most you'd expect. The purple is the actual data. Here we started off this past quarter, and it's a moving quarter, so it's not a calendar quarter. It's the past 14 weeks, exactly matching the least number of offers you'd expect. And basically about 7 weeks ago, you got on the lower side, and 4 and 5 weeks ago, you were more and more below, and now the spacing is roughly the same. So we're quite a bit now below, and you see that you've dropped to 75% from 77%. So that's not much of a drop, but the number of offers have dropped from 2,270, call it, to 1970. So you've had a drop of 300 listings, and that's 15% of your offers. So the volume, the number of transactions has dropped by 15% in just the last 14 weeks. Days of unsold inventory went from 37 days to 40, so a slowing down in the marketplace. You can see that the market normally slows down because were at 10% more and now you're at 12% more. A slightly slower increase than normal, but still pretty darn close to normal. And again, you can see that you were basically above the gray line most of the time. Right here, about 5 weeks ago, we got down to it. And this last week, we got up. Now, the reason we got up this last week is with every holiday, it impacts real estate. Sellers don't want to come on the holiday weekend, so they wait and they come on this weekend. Those listings that came on this past week haven't had time to sell. So you have more inventory with less offers. Time to sell, you can see, is 14 days to 26. So we've almost doubled the time it takes 3 out of 4 sellers to sign in just 14 weeks. But it's not that dramatic on a percentage. It is significant. You've gone from 82%, so 20% faster, to 8% slower than normal. And you can see you're below the gray line here. You're on the red side of the gray line. And now currently on the right-hand side of the graph, you're above the gray line, so closer to the blue line, so you're slower than normal. Ask price reductions, 0.5%, 0.6% reduction. Now it's 1.1%, so almost a doubling of the price reductions. But on a percentage basis, from 30% more than normal to 37% more than normal. And you can see that you were below at the beginning. You caught up, and a lot of it was pretty constant. But again, just the last couple of weeks, this gap has been increasing. Buyer competitiveness, when they go in and make their offer, we went from 9% overbidding to only 5.6% overbids. That's 2.5% more than normal overbid here, and only 0.5% more than overbidding over on the current day. So you're still above the gray line. And again, you can see that we were on the gray line for several weeks in the middle, but we've raised above it. So you can see the market more or less follows the typical pattern, but there are minor changes compared to that typical pattern. Now what we're doing is we're bringing in the 10-year history. We're going back to 2014 up to 2023 is a tighter horizontal axis. In 2023, I expanded it out so you can see the little changes that happen every week that sort of get blended away in the more dense, and then the current data expanded out. You can see the impact back here on July the 4th, very similar impact on Labor Day. So that's the kind of impact we have on holidays. Here's your offers you got down. So next week, I'd expect it to turn around and go up, because you can see the down on July the 4th and then up. So my prediction is the number of offers is going to go up next week, in large part because of the large number of listing opportunities that came on the market this past week. Now what we're doing is we're looking at each one of the components for all of Silicon Valley. So this is Santa Clara, San Mateo, and Alameda County in a blender. We have the condensed x-axis to the left and they expanded to the right of 2023. The gray line is where the 10-year median is. So you can see in 2023, the gray line shows you the seasonal pattern. The red is the least amount of inventory you'd expect. The blue is the most. You can see we started the year with the least amount of inventory you'd expect. Right at the beginning of the second quarter, we gained quite a bit of inventory. And now we're sort of staying at that same level following the normal pattern. You can even see the impact of the holidays in the 10-year median. So that gives you the idea. That's why I say every holiday negatively impacts real estate except for Mother's Day and Valentine's, which have a slight positive impact. And that's basically because the holidays take away people from optional events like buying and selling real estate. Now what we do is we take that gray line and stretch it out so you can see that the market had more increase in inventory, which is going towards a cooler marketplace. Now it's just outside a hot marketplace. In fact, it's basically right at the threshold between a normal marketplace and a hot marketplace, but you can see the increase again, and that's the influx of inventory this week. Now looking at offers, you can see the decrease in offers because of the decrease in inventory last week. There was less new inventory, which is the most likely inventory to sell. You can see how we crossed from above the blue line to below the blue line during the second half of the second quarter through the second half of third quarter. We're now in very low offers because we're below the blue line. We have less offers than you would expect. And here you can see you're down at about 75% of the offers you'd expect. Actually, it's probably closer to 74%. Normal would be up here on the gray line. Here's looking at days of unsold inventory compared to the 10-year median. You can see this is just about right on the gray line. So it's very typical speed of the marketplace. So we're not faster or slower. So even though we have a lack of offers, we also have a lack of inventory that's causing the DUI to be about balanced. It's slightly slower than normal because you're above the gray line favoring on the blue line side. Here you can see the pulling out the gray line. So this is normal. So you can see there's a huge slowdown. And again, a lot of that has to do with the holiday. Here is the marketing time. So this is the easy to understand concept. It's taking right now something like 26 days to sell 3/4 of our inventory for Silicon Valley. Typically at this time of the year, it's hard to really say. That'd be 24 days. So it's taking 2 days longer. No one's going to really notice or complain unless they are really looking at the detail. But even in a real slow marketplace, it's only somewhere around 32 days. So it's a pretty tight metric. And in a super hot marketplace, it's 18 days. You have some fluctuation, and right now we're 2 days slower than normal. Here you can see the purple line is above the normal line, so it's slower than normal. Almost 10% longer marketing times right now. But again, because Silicon Valley is so quick, people really don't see that. Here's the ask price. So the few sellers that are taking ask price reductions, because the frequency that we'll see in the next slide is just about normal. The sellers that are taking price reductions are taking significantly larger price reductions. Right now on the largest 10%, they're taking about a 13%, a little more than 13% price reduction, probably about 13.5%. Here you can see it's up here. So that 13.5% is 20% more of a price reduction than normal. This is now looking at the average. I do the 10% because I think it's more representative of the marketplace because it's such a tight metric. And because so many of the sellers don't adjust the price, but it's so much more common to look at either average or median. So I'm bringing in the average just to show. So here again, you're below the gray line. So you have more price reductions or larger price reductions than happening. And here you can see larger and you can see the step down. This last week, we were pretty flat. So here's the frequency. So here you can see you're very close to the gray line, a little bit more common this week. So that's why I was saying a couple slides back, the sellers that are taking price reductions are taking large price reductions than they normally do. Here you can see the increase in the frequency of price reductions. This is the buyer's overbidding. So you can see overbidding is also favoring the seller because it's a little bit more common. And it's somewhere around 3.5% overbidding right now. And that's for all 3 counties. Here you can see that you're a little bit more above because if it was normal, it'd be here. So it's about 0.5% more overbidding than normal. And here's the frequency of overbidding. The frequency of overbidding is it's a little bit higher, so it's favoring the seller. and the number is somewhere around 66% of the sellers are getting overbids right now in the 3 counties. Here you can see compared to the normal. So if it was normal, we'd be on the gray line. We've been bouncing around. You got a little bit closer last week, and now you've cooled off a little bit this week. Here's the price on log paper, the thin straight line that's sloped up. That's sort of the average typical appreciation. We have this V down at the end of the year, and then we have sort of the U up at the second quarter of every year. Very consistent price cycling. And you have to look at it as because it's sold prices. So the peak up really starts earlier in January, maybe middle of January. And it varies a little bit from year to year, but it's very consistent. It ends about middle of second quarter, and then you turn around and come back down. This last week, we actually saw a little bit of a price increase, but you can see that you've had sort of little stumbles at this time of the year. So it's sort of the improvement. And then as you get to Halloween, you expect another dip down. Here's the estimated payments. Then this is the most expensive property up here. And this would be $24,000 a month if you're buying them 90% price on an 80% loan. The typical payments down here somewhere around $11,500, and the most affordable home is somewhere around $6,200 for a monthly payment, and that includes taxes and insurance. Here's your 3 counties breaking out. So now you have Santa Clara County in the blue, Alameda County in the gray, and San Mateo County in the orange. You can see San Mateo County has roughly the right number of inventory. Santa Clara County is below Alameda, and typically before the pandemic, they were very similar. So Santa Clara County is the county that's got the least inventory compared to normal. Here's the number of offers accepted. Santa Clara, even though it had fewer inventory, is having more offers accepted than Alameda County and San Mateo County. All 3 counties are less than normal, but I suspect that Santa Clara County is going to have the fastest DUI. And yep, here Santa Clara County's got the fastest DUI. San Mateo County is second. And Alameda County is the slowest DUI, days of unsold inventory. This is the turnover rate of the marketplace. And it's not bad. It's something like 45 days. So you're selling out your entire inventory in a month and a half at the existing rate of sales. But and it's also the longest marketing time. This is the time to sell 3 quarters. So Alameda County is the slowest at 30. San Mateo County is second at 27. And Santa Clara County is the fastest at 22 days. And here's your ask price reductions. So San Mateo County is doing the most price reductions. Santa Clara County and Alameda County look like they're tied right on top of one another because I can't see both of them. I just see one line. This is the frequency of price reductions. Alameda and San Mateo County are doing the most price reductions. So even though Santa Clara County is doing less price reductions, the sellers that are doing those price reductions are doing larger price reductions, so that the average price reduction is the same in Santa Clara County and Alameda. If you were looking just at this slide with the lower frequency of price reductions, you'd assume that the price reductions average would be lower, but the magnitude of the individual reductions are higher, so the average worked out to be the same. So even though Alameda County was the slowest and largest marketing time, it has the highest overbidding. So for whatever reasons, the buyers in Alameda County are feeling the need to overbid more than the buyers in either San Mateo County or Santa Clara County. You can see each county. Santa Clara County is just under 5%. San Mateo County is at 5.5% overbidding, and Alameda County is at 6.5% overbidding. This is the frequency, very close together in this metric, all just under 70%. The lowest is Santa Clara County, which again is not what you would expect for the fastest market time. Santa Clara County has the fastest marketing time, but has the least frequent overbidding. Here's your price appreciation. Santa Clara County has the highest appreciation since 2015. San Mateo County has the lowest. Here's your prices. I drew in the horizontal line so you can see that San Mateo County is actually below their pricing in 2021. Santa Clara County is significantly above, and Alameda County is below. So you have 2 counties out of the 3 that are below, and Santa Clara County is bucking the trend above where they were in 2021. Here's your same information on regular paper. The previous was on log. Here's the estimated payments in the same order, but Alameda County is the more affordable county with a monthly mortgage payment of about $7,200 a month. Santa Clara County is next at about $13,250, and San Mateo County is the most expensive, about $13,050, and that's $13,500. This slide is up here simply to show the lack of offers. Last year we had fewer, but this is the second worst year out of the last 10, but it's the third worst out of the last 25. So 2007 was lower than even 2023 for the last 2 weeks. So the 2007 slowdown was in full force at this time of the year. Here's the actual numbers for either Silicon Valley as a whole or each one of the 3 counties. You can come back and look at the metric. I do want to note, just because it is sort of obvious, a large increase in the number of new listings on the marketplace, but basically 5% across the board. The total inventory increased by more, and the number of offers accepted was down. That caused the DUI to go up fairly significantly by 4, 6, and 6 days. Typically, I say 5 days is my warning level, but because of the holiday, I'm not alarmed at this at all. I expect that numbers to rebound next week. So we've been talking about the Silicon Valley real estate market analytics for September the 7th. We will be going on to the Greater Bay Area, 13 counties and 5 regions. The blue is the YouTube archive if you want to type that in. If you want to do less typing, you type in the green root URL, and that becomes key, because if you want to join Saturday Morning Live, you just put in the green root URL and 2024 for the year. If you want any Pacific handout, it is up. Type in the green root URL, H for handout 2024-09-07, and you'll get about 67 pages of the PowerPoint that I just went over, and any episode, green root URL, year, month, date code. I'm Richard Calhoun, real estate broker, realtor here in Silicon Valley. My contact information, representing buyers or sellers here in Silicon Valley. Would appreciate you subscribing once and like each of the videos. Let me see if I have any questions. Not seeing any unmuted mics, so I'll move forward and cover the 5 regions and the 13 counties. Here are the 5 regions. The first slide we're looking at is active inventory. So this is the current level of inventory in those 5 regions. You can see that the Central Coast and the cities are much smaller in size, and therefore they have less listings. Silicon Valley is normally quite a bit less than the Central Valley and the North Bay, but they're fairly close together now. There's only about 500 listings that separate them, and if you come back here to normal timeframes, that's closer to 1,500. The size difference right now is a whole lot the active inventory, and that's how much inventory the buyers have to choose from. Then flipping over and looking at the demand side, the number of offers, you can see that again, the Central Coast and the cities are much smaller. Here, the Silicon Valley outperforms both the North Bay and the Central Valley. Silicon Valley has less inventory and yet is selling more homes. Therefore, the speed of the market is a lot quicker. And we measure that speed of the market 2 ways. The first way is days of unsold inventory. This is a theoretical number of how long it would take to sell all the existing inventory. You can see Silicon Valley is the fastest at 42 days. Then you have 3 areas, basically the cities, the Central Valley, and North Bay, right at 60 days to get rid of all their inventory. And the slowest region is the Central Coast at 85 days to sell their inventory. Here is a simpler to understand metric. This is simply how long does it take 3 out of every 4 sellers to sell their properties. Here in Silicon Valley, that's 26 days. Next is the Central Valley at 35 days. Then you have the cities at 41 days. And I would call it Central Coast at basically 46 days, and North Bay at 47 days. In respect to the rest of the nation, selling all your or 3/4 of your inventory in a month and a half is a fairly fast-paced marketplace, but Silicon Valley is doing that in less than 4 weeks. Now what we're looking at is price reductions. Here's 100%. That's the sellers are getting exactly their asking price, and you can see there have been times when both the Central Valley and the Silicon Valley have been above the line. Right here, the cities equaled the line, basically. It might have been a tad above, but basically it's been a trend that's been basically reserved for the Central Valley and for Silicon Valley. Right now, Silicon Valley is taking the least price reductions. You can see that sellers are getting about 98.9% of what they're asking for, or they're taking about a 1.1% price reduction. Then the Central Valley is next, and there the sellers are taking about a 1.4% price reduction. Then you have the cities taking a 1.8% reduction. The North Bay is just shy of 2% price reductions, and the area taking the largest price reductions is the Central Coast at 2.7%. Notice the rate of which all 5 regions are basically increasing now for some time. The cities had a little reversal for a while, but basically all 5 regions are taking larger and larger price reductions as we come into the slower time of the year. Here's the frequency of those seller price reductions. So in Silicon Valley, that only something like 18% of the sellers are doing a price reduction. The cities is at 20%. And look at the increase here. So it's becoming more and more common that the sellers are taking price reductions. Central Coast is just shy of 30%, and Central Valley and North Bay are just a tad above 32% of the sellers are taking price reductions. So approaching 1 out of 3 sellers taking price reductions. This is the magnitude of overbidding. So we're flipping over and looking at how competitive the buyers feel the market is. And the most competitive marketplace right now is the cities at just 6% over the seller's ask price. Silicon Valley is next at 5.5% over their asking price. Then we drop all the way down to the North Bay at basically 0.7% over their asking price. The Central Valley is essentially a hair over their asking price, and the Central Coast is a hair under their asking price. This is the frequency of those overbids. So we can see that in Silicon Valley, 66% of the sellers, so basically 2/3 of the sellers, receive an overbid. In the cities, that number drops down to about 56%. In the North Bay, it's 46%. In the Central Valley, it's about 44%. And the area with the least frequent overbidding is the Central Coast at 36%. So a lot of 6s in that. Now we're looking at total appreciation since the last 9 months of 2015. So I was looking for a year period of time with stable pricing, only found 9 months. So basically April 1st, 2015 through December 31st, 2015. The cities has had the least amount of appreciation at something like 27% appreciation. And then you have the North Bay at something like 64%, the Central Coast at 78% appreciation. So that's getting close to doubling your money. Silicon Valley is at about 81% above their original price. And the area with the highest appreciation is the Central Valley at 90% appreciation. And notice that all these areas, again, are going down. When you start looking at regions, they are more or less moving in lock, stock, and barrel. They don't start necessarily at the same time, but right now everything's on a downward trajectory. Here's the sale price, which is also down in all the 5 regions. It's closer to being flat in the Central Valley, but it's still down a little bit. The North Bay is down. Then your Central Coast is next most affordable. Now we've had a little bit of reversal because if you look before the pandemic, the cities was always more expensive than Silicon Valley. We crossed over here in 2023 for a little while. We were neck and neck for most of 2024, but right now Silicon Valley here in the purple is almost at 1.6 million, and the cities is 1.5 million, separated by about $100,000, with Silicon Valley being the more expensive of the 2 regions. Moving on and looking at the monthly payments, this assumes an 80% 30-year fixed loan at the national average of 6.35%. You can see that they're in the same order as their prices, with Silicon Valley pulling ahead, being more expensive than the cities in the orange. Central Coast is down here at about $8,000 a month payments. North Bay is going to be at about $5,750 a month roughly in payments, and Central Valley is the most affordable at about $4,100 a month payments. You can get lower interest rates by doing an adjustable, but having relational pricing with the bank, or even just borrowing jumbo money versus conforming money. Here is the data for the 13 different counties. I also have the region for Silicon Valley. I also added in a region that we didn't talk about for the Bay Area. I did the 9 counties that touch the Bay only because the media talks about that quite a bit. I think it's a garbage number. If we look at something like the time to market the property, the Bay Area number is 40 days. But if you look at it, it ranges down from a low of 24 days in Silicon Valley to a high of 75 days in Napa. You're almost double the speed in Napa and you're almost half the speed in Santa Clara County. Talk about any number like that is just, the number's accurate. They're not calculating it wrong, but it doesn't really tell you what the market's doing. And that's why I really don't focus on it. But it's just there to see so that you can see the numbers in case if you want to compare my numbers to what the media reports. And there are going to be differences just because we all use different methodologies. But you can pick out whatever metric you think is most important and see what's going on in any one of the 13 counties. And with that, we're done with the presentation. I appreciate you joining me this week. Share, like, and see you next week. Take care. Bye for now.